Have you ever wondered how economists track a country's wealth, figure out how much workers are paid, and measure what businesses actually contribute? It might sound complicated, but today we're going to break down three key economic ideas that explain it all: GDP per capita, gross earnings, and gross value added. And don't worry, we'll keep it simple and clear. First up, let's talk about GDP per capita. You might have heard it called the average income per person. It's pretty straightforward to calculate. You take a country's entire gross domestic product, or GDP, and divide it by the total number of people living there. This number gives us a rough idea of how much income each person would get if the nation's earnings were split evenly among everyone. Generally, a higher GDP per capita points to a higher standard of living and more economic prosperity, while a lower one suggests the opposite. Next, we have gross earnings. This is all about what an individual worker makes. Think of it as the total amount of money an employee receives from their employer before anything is taken out. This includes their basic salary or hourly wage, plus any extra cash they might get from working overtime, hitting production targets, or receiving a performance bonus. So, gross earnings represent a worker's total pay packet before deductions like taxes or pension contributions are made. It's a great way to see the direct financial reward for their labor. Now, let's move on to gross value added, or GVA. This one might sound a bit technical, but the idea is simple. GVA measures the value a company or industry adds during the production process. You calculate it by taking the total value of the final goods or services produced and subtracting the cost of all the materials and services used to make them, except for labor. So, things like raw materials, electricity, and components are subtracted. In short, GVA tells us how much new wealth a business has created for the economy. So, how do all these concepts connect? It's a really neat circle. Gross value added is a crucial part of the puzzle because it's roughly equal to the total wages paid to workers plus the total profits earned by the business. When businesses become more efficient and create more value, their GVA increases. This means there's more money available to be shared as higher wages for employees and bigger profits for the owners. As incomes rise across the board, the nation's total GDP goes up, which in turn boosts the GDP per capita. It shows a direct link from business productivity to our overall standard of living. Let's use a quick example to make it crystal clear. Imagine a small factory that manufactures furniture. In 1 year, they sell $1 million worth of tables and chairs. To make that furniture, they spent $600,000 on wood, screws, and electricity. The gross value added by this factory is the difference between the two, which is $400,000. This $400,000 is then distributed. Part of it goes to the workers as their wages, and the rest becomes the company's profit. Both of these contribute to the national income. So, to recap what we've learned, GDP per capita gives us a snapshot of a country's average income. Gross earnings show us the total pre-tax pay an individual worker receives. And gross value added measures the actual economic contribution of a business. By understanding how these three pieces fit together, we get a much clearer picture of how an economy works, where the money comes from, and how it impacts our everyday lives. I hope this explanation made these economic concepts easier to understand. If you found this video helpful, please give it a thumbs up, share it with your friends, and make sure to subscribe for more simple guides to the world of economics. Thanks for watching.